Welcome to Educational Alpha. I'm Bill Kelly, CEO of CIO Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill Kelly is joined by Corey Hoffstein, a notable figure in quantitative finance and the co-founder of Newfound Research. Corey revisits his unexpected journey from an aspiring video game developer to a financial strategist driven by a passion for quantitative finance. The discussion centers around the concept of return stacking, a strategy developed to enhance portfolio diversification without sacrificing traditional asset classes. This innovative approach aims to leverage modern financial tools to navigate and harness the complexities of today's investment landscape, enhancing potential returns while managing risk through diversified beta rather than chasing elusive alphas. Listen in.
Corey Hoffstein, welcome to Educational Alpha.
Bill, thank you for having me. Delighted to be here.
And I think Dylan Pierce, a CIO member, and when CIO members ask me to do things, I try to respond in kind, and he was kind enough to have made this introduction. I know you've done some work with CIO. My colleague Aaron Philback, I think, has something coming up with you maybe next week.
Yeah, very excited to do a nice panel presentation all about hedge fund replication with him and a couple other big names in the industry on that space. It's been a delight working with you guys and looking forward to working more with you in the future.
No, the pleasure's ours. Sticking to the Educational Alpha script and theme, maybe a little bit on your background first, and then we can talk about the heres and nows in the current market environment.
I say I tripped and fell into this industry. I originally thought I was actually going to develop video games for a living and got to college to do my computer science degree and quickly realized that it wasn't the way I wanted to spend my life and made a quick pivot. I learned about this world of quant finance actually through an article in a magazine. And I said, this is really fascinating. And I started dedicating all my time and learning to taking my computer science background and applying it to the world of finance. Right out of undergrad, I graduated in 2009, not a great year for hiring. So I decided to continue my schooling and went to Carnegie Mellon's computational finance program, which is a master's degree all about financial engineering. And at that time was largely dedicated towards derivatives pricing. They've sort of changed the program at this side to be a little less sell-side focused, a little more buy-side focused. At that time, everyone's real goal was to get into sales and trading on Wall Street, helping price and sell complex derivatives. Again, a lot of those jobs disappeared by the time I got out of grad school, but I was fortunate that I had started this business called Newfound Research, really again by accident. Through the work I was doing in high school and college, I had developed some quantitative models that a local asset manager I had met outside of Boston was interested in licensing from me. And so I spun up this small LLC and I said, great, I'll sell you some quantitative research. And that started to generate enough cash flow that I said, you know what, this is a great time in my life to try an entrepreneurial venture. A lot of those initial models were built around dynamic trend following and momentum signals. And as I got out of grad school, I expanded the types of models that we offered. And over time, eventually moved from providing research to becoming a sub-advisor and an index provider. Eventually moved as a firm from index provider and sub-advisor to directly advising our own suite of mutual funds. Eventually sunset those. Would love to discuss at some point this transition, but sunset our mutual funds and launched a suite of ETFs. And that's really what we do today. We are one half of a larger joint venture that runs a suite of ETFs called the Return Stack Suite. We're really excited about, we just brought those to market last year and really excited about the future of that product suite.
Interesting background, Corey. And we just had the passing of Jim Simons last week. And I think he probably understood the opportunity for quants in this long before you and I were born. But it's interesting that you came at this with a computational background, and that used to mean maybe a quantitative career, which maybe is what you've done. But now we have generative AI and all forms of disruption around that. Do you see an interesting play there? Isn't this the next gen for quantitative research?
Things like machine learning, I think, have long been established as having strong use in the world of quantitative investing. AI, I think, certainly will play a role. I had a great conversation on my own podcast, actually, with a gentleman named Bin Ren, who runs a firm called SigTech. I thought he had a great perspective on this, which was the role has always been and will always continue to be about asking the right questions. All that's really changing is the tool set, how you can ask those questions and ask them more effectively. And AI will hopefully continue to evolve at a pace that allows us to be simply more effective in asking those questions. But the creativity will still live on our side, that we still need to ask the right questions.
I agree with all that. So back to your day job and Newfound Research. So it's going to be an interesting conversation, Corey, because I think so much of what we're talking about is private credit 24/7. I just got back from Toronto last week, private credit panel. I just going down to Florida Wednesday, private credit panel. And it seems that investors are always chasing that white hot dot. And before this is private equity. And it's interesting when I think about some of these tradable strategies and what they could perhaps do for the investor, both their behavioral aspects and maybe their portfolio as a whole, is what are they worried about? They're worried about volatility and drawdown risk. And what is the solution in front of them? Hedging is maybe one way to put it. I think coming out of the GFC, where you were starting your career, maybe that was the advent of liquid alts in the mutual fund space. And that maybe was first gen product, and you might have some views as to put aside the wrapper for the moment, but maybe the wrapper is part of the issue, what worked and what didn't work. But I think when you're putting complex strategies into a highly regulated wrapper, some of the value proposition does get rinsed away because there's limits on leverage. Transparency is very, very different, concentration of holdings, et cetera. So as you came into this industry 16, 17 years ago, whatever the number was, what was the state of play then versus now? And hopefully we've improved some things. Maybe the talk about diversification and throwing the hedge fund under the bus, maybe unnecessarily. So there's a lot of observations wrapped in there.
What I certainly saw post 2008, I should really distinguish this. I've largely always operated in the financial advisory channel. So this is not sort of the institutional view, but what you had post 2008 was a demand for protection for sure, but a fear of derivatives. So I remember product brochures that would say no leverage, no derivatives, no shorting. That was a selling feature. We had pre 2008, but on the retail advisory side, 130/30 products that didn't work. You, in the institutional side, obviously heard about all the derivative problems, but portable alpha really struggled for a variety of, I think, operational reasons. And then post 2008, you had the early days sort of V1 liquid alternative products. In particular, things like CTAs got packaged up and put into mutual fund products. At the same time, you had a dramatic rise in the use of ETFs. I think 2008 provided an opportunity. You saw the ETF product set take off. It gave people the ability from a tax perspective to switch from mutual funds to ETFs without taking a big tax hit. The number of ETF products that were out there exploded. And you saw this huge rise in tactical ETF strategies. That was another area that went from zero to hundreds of billions of dollars over the next 5 years. And a lot of those trends were early attempts, but none of them, I think, if you look today, have really continued to get as significant traction as long-term solutions. I think what you are seeing is the market said, okay, actually the appetite for some derivatives is okay. We've seen a huge rise in option-based ETFs, for example. We've continued to see a rise in things like CTAs. But again, that space had a behavioral friction problem we can talk about when it didn't keep up with stocks and bonds. You've seen a lot of other things move into the private space for what I would argue are behavioral reasons. to steal a term from Cliff Asness, they're ultimately laundering volatility, making it easier for investors to stick with some of these products by simply hiding the returns by marking their NAV less frequently. And so you've seen a number of different ways in which people are trying to solve these problems. The fundamental problem remains the same, which is people want diversification, but actually implementing diversification in a standard liquid portfolio comes with all sorts of hurdles. And I think that's the continuous problem a lot of people in this industry are trying to solve. And it's the same one we're trying to solve with our suite of ETFs.
Maybe sticking with this theme for a couple minutes because it does interest me, and I may have stolen this line for something that you wrote. But when the investor thinks about diversification, they want expensive alpha. But if they look around, there's never been as much choice for cheap beta. And we put out a report a year or two ago, and Mark Anson looked at the current state of play, and he made the thesis that it was under this portfolio for the future that beta is the new alpha. And he talked about the ETF space, and then and now it's, I think it's 7 trillion, maybe it's a bit bigger than that now, but probably somewhere between that and say 10. And he talked about all of the various offerings of very cheap beta and to be able to build a diversified portfolio, but then some of the inefficiencies. And he picked on an ETF that is trying to replicate some kind of Indian-based stock exchange. But he looked at the number of days where the Indian market was closed and the US market was open and the inefficiencies that you could get, and talked about the tracking error and the R squared between the two. And it was a very interesting discussion. So I think would the investor be better served to look at all of this cheap beta that they have and the ability to put together a pretty good diversified portfolio versus chasing alpha and to have an alpha engine that's consistently compounding? Very, very hard to find, particularly in the public market. So what are your views in that? I don't know if this is one of your top 15 in your 15-year anniversary, but I did read something that you talked about making this comparison.
So the long-term trend is everything that typically was alpha becomes beta over time. We can look at the last decade and look at a lot of equity quant strategies that perhaps were alpha in the 80s and 90s that were then identified as academic factors that got prepackaged into building block ETFs that were then called smart beta, but in many ways, they're just a new form of beta. And I think one of the things that happens in this industry is we are alpha obsessed. We only think we're doing our job if we're delivering alpha. But if we take a step back and look at a standard, call it 60% stock, 40% bond portfolio, that portfolio doesn't know whether you're making an improvement to it by adding alpha or by adding some novel diversifying beta. I will say my confidence that I can access novel diversifying beta is a lot higher, and my confidence that it'll continue to work is a lot higher than my confidence in that I can find alpha from a portfolio management perspective. So from that perspective, I think we often overlook the low-hanging fruit of portfolio improvements that we can make in search of trying to do the hard thing because we think it's the right thing. And yet we find many allocators continue to fish in the same overfished pond. We can all quote the SPIVA reports. We can all quote the Morningstar reports about how hard it is to find a large cap stock picker that actually beats the market. And even if you find them, the probability of them beating on any given year is pretty much a coin flip. And yet that tends to be where the majority of people take the active risk in their portfolio rather than saying, let me just admit I'm going to be passive in equities and try to take more tracking error in my portfolio through some novel diversifying beta rather than, again, trying to fish in the same overfished pond. So this is something I feel very strongly about. Look, you don't get bonus points for doing this the hard way. But I think people feel cheap doing it the easier way. And I would just argue, do it the easy way. All that matters at the end of the day is the returns you generate.
Corey, explain to me return stacking. How should the listener think about return stacking?
I think explaining what it is probably best explained through the problem we're trying to solve. And the problem we're trying to solve is when people try to introduce alternatives into their portfolio, it is often this problem of addition through subtraction. What I mean by that is most people aren't starting with a blank piece of paper. They're starting with a portfolio that prototypically looks like a 60-40, 60% stocks, 40% bonds. So let's say you want to introduce a novel diversifying beta like managed futures trend following. But what that means for most people is that they need to sell some stocks or sell some bonds to make room. And that process to add managed futures means you have to subtract stocks and bonds has two important implications. One is it changes the hurdle rate for which managed futures have to overcome for them to be additive to the portfolio. If stocks and bonds do well, it creates a higher hurdle rate. And that was a lot of the problem in the 2010s was managed futures went sideways while stocks and bonds had an absolutely gangbuster decade. The second is behavioral. Most investors and advisors who are allocating on behalf of end investors, those end investors understand what stocks and bonds are. They're low cost, tax efficient, productive assets that they can probably explain to you. They can't do the same for managed futures. It's a trading strategy they probably have very little concept of, which means they're going to have very little tolerance of its tracking error. And so firms have historically tried to solve this a couple of ways. The first way is you just ignore it and you try to educate your client through it. And that's really hard, particularly when you're talking about diversifying betas that maybe only have a Sharpe of a 0.4 and might go through a 5-year drawdown while stocks and bonds are doing well. Most likely, you're either firing the strategy or you're getting fired as an advisor. The second way, and you had a great conversation with Kevin Donahue from Abbey, and they do this, which I call it the spoonful of sugar solution. So Abbey's multi-asset strategy does this, and Standpoint's multi-asset strategy, they do this. They combine traditional assets with alternatives in the same fund. So if you give Abbey or Standpoint $1, they'll give you 50 cents of stocks, and they'll give you 50 cents of a managed future strategy. And hopefully that line is smoother because of the internal diversification, and they're giving you a little bit of that stock sugar to make it look enough like stocks that people can stick with it. And the managed futures medicine gets snuck in there. The way we look to do it is the way that institutions have done it. And this is sort of the third approach. And this is the way institutions have done it going back to the 1980s with PIMCO, which is we say, we're going to use a little bit of leverage. For every dollar you give us, we're going to give you $1 of either core stocks and bonds, and then we're going to give you $1 of some alternative investment strategy. So for example, our flagship ETF, our return stacked US stocks and managed futures fund, every dollar you give us, we'll give you $1 of effectively large cap US equity exposure plus $1 of a managed futures fund. So that it's not this either or decision. If you have a 60-40, you can sell some stocks, buy our fund, you keep that stock exposure, and now the managed futures are layered on top, whether that's in the pursuit of adding more diversification or in the pursuit of adding an additional return stream that could lead to some excess growth in your portfolio.
So if you think about that strategy now versus circa 2020, 2021, when the risk-free rate was at 0, is it more difficult given the fact that money is not being given away? And if the answer is yes, what are some of the challenges and how does a mark-to-market work? Because you've got to be truing up the underlying, I would assume, at periods of time.
It largely depends on the strategy, but I would say that the answer is largely no for what we would call cash plus strategies. So managed futures is a cash plus strategy. When you invest $1 with a managed future strategy, they're going to take that dollar and put it in T-bills, and they're going to use those T-bills as collateral for running the P&L strategy on the futures that they trade. All we're doing is saying, get rid of those T-bills and put them in the S&P. And so long as you think the S&P is going to outperform T-bills over the long run, then that's perhaps an attractive trade-off you might want to make. Not everyone wants to necessarily make that trade-off in the short run. There's plenty of people who look at T-bills as a very attractive nominal return stream today, and that's totally fine. But for people who are thinking sort of longer term and think that ultimately the equity risk premium floats on top of the risk-free rate, it might expand and contract, but ultimately it should be positive on top of the risk-free rate. All we're saying is swap those T-bills into the S&P, keep the same trading strategy P&L as best we can, but all we're going to do is change the underlying asset. And so you can do that for things like systematic macro strategies, all sorts of CTA strategies, carry, managed futures trend, what have you. I think trading futures, that's very effective. Long short equity is another space that this is conceivably possible. Or you can even do things like keep your core stocks and bonds and stack more strategic diversifiers on like gold or commodities. And so there's all sorts of flexible ways in which this can be done, taking advantage of the capital efficiency embedded into futures contracts.
How am I getting the exposure either to a CTA or a specific hedge fund strategy? Is it a single manager? Is it through a fund of funds? Because this concept of over diversification doesn't work so well either.
Yeah, so it depends on the product that we manage. Going back to our flagship product, there's a sub-advisor. We're one of two sub-advisors on the fund. The other sub-advisor runs the trend following strategy. And this is a replication-based strategy. So again, going back to your conversation with Peter Donahue, managed futures is a space with massive dispersion. There's so many degrees of freedom of choice in how you can run a managed future strategy that even in a year like 2022, which was ostensibly a great year for managed futures, you can have massively positive P&L and some managers had negative P&L just because they happen to skew towards different assets or trade different trend speeds or what have you. And so what we said is we want a product that could hit as much down the middle of the fairway as we can, defining the fairway as the SocGen trend index as our benchmark, which is implicitly an index that is a virtual fund of funds. It allocates to 10 of the largest trend following managers who are willing to report performance daily and are still open and predominantly trade trend. So these are names like Man AHL and PIMCO and AQR. And what we do is we run a replication-based approach where we look at the prior returns of that index and we try to effectively replicate what we think they're holding. And there's a couple of ways we go about doing this, but we try to replicate what we think those managers are holding to try to create a return stream that looks as much like that basket of managers as we can.
So this return stacking then, is it more of a diversification play to get exposure to more uncorrelated beta as opposed to going to find this alpha engine to stack onto it? Is that a fair way to look at it?
We would say there's really two uses. The first thing I would say is we want to be careful about what we're stacking. You could, in theory, take a 60-40 and just stack more equity, but I would argue you're just stacking more risk. So if we're going to use leverage, we want to use it prudently and we want to use it to unlock the benefits of diversification. But we have people who use it two ways. There's people who look at this and say, I'm a retiree and 2022 was a big wake-up call about stock-bond correlation, particularly during inflationary regimes where their purchasing power really matters. They're taking withdrawals. Wow, trend following does really well historically during those regimes. Maybe I can add a trend following overlay as a bit of a hedge. So there are folks who look at this and say, this is a defensive approach. But then we have other folks, particularly like young, aggressive investors who say, I'm invested 100% in equities, which technically is against every finance 101 lesson there is. And arguably 100% equities is a very overly concentrated, under-diversified portfolio. And they say, well, maybe we can use this return stacking concept to add an additional return stream, use a little bit of leverage and not just be 100% equities, add some diversification, but more importantly, add another additional return stream on top of what we're doing to try to eke out another 100 or 200 basis points of annualized returns. And they're doing that instead of pursuing alpha. Instead of saying, let us try to find stock pickers that can beat the market, they say, why don't we just get the market and we'll try to quote unquote beat the market by stacking on this totally different return strategy like managed futures that we have a high degree of confidence should generate positive returns over the long run.
Could you just compare this, Corey, to risk parity? Is risk parity a cousin of return stacking or something completely different?
I would absolutely say risk parity implements return stacking. Return stacking is a brand name we came up with. Again, it goes back 40 plus years in the institutional allocator space. What risk parity is just basically the implementable ideas of Finance 101. Find a max Sharpe portfolio and lever it to the risk levels you want. Whether we call it leverage or portable alpha, which really focuses on adding alpha strategies, or capital efficiency or return stacking, they're all really the same thing. We're trying to say, let's get a more diversified portfolio and use leverage to unlock those benefits. So in our case, we're not just combining stocks, bonds, and commodities. Our products are more singular building blocks that allocators can use to stack different things on top. If people want to build a risk parity-like portfolio, we've helped people do that. If people, on the other hand, say, look, I really like my 60-40 framework and I just want to stack some alternatives on top, we can help them do that as well.
Makes sense. Maybe slightly turning the page, taxes, they're not going away. And if they're going anywhere, it's up. We're running massive deficits and debt, and this somehow has to be financed. And we've got a retirement system publicly with the Social Security system that's broken, and nobody seems to want to fix it. If you try to fix it, you don't get elected. So I don't know where that's going. So eventually taxes are probably the only way, at least in the short to medium term, to pay for it. But I don't know if we spend enough time talking about after-tax returns and the efficiencies of, say, an ETF versus a 40 Act wrapper. I think the industry has been very good at producing product for the investor, but outcome solutions less so. How do I retire? How do I liquidate some of these assets? And just to put a little bit more icing on this cake, I had Daniel Shapiro from Cerulli on just a handful of weeks ago. And I joke with him every time I see him, this transfer of wealth number gets bigger and bigger and bigger. And now it's up to, I think, approaching $90 trillion. And I think the owner of those assets would like to pass them on as tax efficiently as possible. And maybe they put some things in place there too. But I think when you think about this enormous transfer of wealth, I think people are going to have a tendency to pay more and more attention to something that's been very real, which is taxes. How does that factor into your calculus and thesis about what you're trying to accomplish, maybe the movement from 40 Act to ETFs? And as an industry and a population, are we spending enough time and thought on after-tax implications and returns?
Taxes are hugely important. I think this is an area where advisors can add a huge amount of value in asset location for their clients. It's something we think about a lot in building our products. We want to build them as tax efficiently as possible, and it's why we chose the ETF vehicle. But there are some ways the ETF vehicle doesn't provide any advantage versus a traditional mutual fund for things like when you trade futures. One could argue the mutual fund is a superior vehicle for trading futures, and I can get into that if you'd like. But the tax efficiency built into an ETF comes from the create redeem mechanism and a tax loophole that effectively allows the market makers to get put securities and not have to pay the original tax basis. So you can sweep securities in and out. And if you're very good at your trading or you've got good relationships with your market makers, you can have all sorts of turnover in your ETF product, trading stocks and bonds, and now options. They figured out how to do this legally with options, that you can avoid taxable turnover, which is a huge advantage for both active and passive strategies, because even passive strategies have some turnover in them. So huge advantage for taxable accounts. Doesn't work with futures. And so any P&L you generate in futures is going to get taxed the same, whether it's in an ETF or a mutual fund wrapper. And to that, we usually say two things. One, when in doubt, put them in qualified accounts. And I think that's really important. Again, I think asset location is a hugely powerful tool at people's disposal, hopefully. And then the second thing we often talk about is, again, going back to this idea of how confident are we that we can generate excess returns? Let's say I have an active stock picker who's going to basically give you the market plus some active P&L. And then you have a strategy like ours that's going to give you the market plus some active P&L from a futures trend following strategy. Do we have more confidence that the trend following strategy is going to generate positive excess returns over time versus the alpha strategy? I do, but I'm very biased. And then I say, okay, how much of that is going to get eaten up by taxes? Is it still attractive after taxes? That I still think there's enough positive return generated there to overcome the tax drag that there will be. And this is still an attractive additional return stream. Again, I think so, even if you have to hold it in a taxable account. But I do think it's something everyone should look at, because minimizing costs and minimizing taxes are two of the biggest levers we have in generating excess returns. I absolutely think those are hugely crucial. I will say, though, I know a lot of people point to the tax issue being the issue driving the movement from mutual funds to ETFs. And certainly don't get it wrong. I think that's maybe 80% of the answer. But I think there's two other things that a lot of people miss, is that ETFs actually in the 2010s had a very distinct marketing advantage versus mutual funds. They were able to market hypothetical back tests via indexing, and mutual funds were not allowed to do that. That's why you saw the rise of smart beta, because they're effectively selling these back tests. And FINRA typically doesn't allow you to show a back test with a product. If you indexed your product in an ETF, you were allowed to show the index back test. Mutual funds were not. So huge marketing advantage. And then two, ETFs avoided largely paying a lot of the platform fees that mutual funds had to, which made mutual funds more expensive. As an example, a lot of mutual funds on a platform like Fidelity or Schwab end up paying anywhere between 20 and 40 basis points in platform fees, which effectively gets passed on to the investor. ETFs largely avoided those fees. They are now coming to ETFs. We'll see if that ends up increasing the cost of ETFs over the next couple of years.
It may be a somewhat related topic. I saw in my Barron's on Saturday, Gary Gensler's smiling face, and whether or not his term is going to end at the end of this administration, we'll see. But one of the big criticisms about Gensler and regulation is too much all at once, and not so much going to debate that point. I think that maybe the record speaks for itself. But if you look at the unprecedented amount of access that we have and the level of sophistication going from the Abu Dhabi Investment Authority to the average Joe or Jane on the street, it's changed a lot. And I think being a regulator is difficult. They serve their purpose. And I would love to be able to say, well, do we need to protect the investor? Yes. But with more transparency, more education would be more desirable than reams and reams of regulation. I think the challenge you run into with more regulation is that the very business model so many of us are trying to bring forward gets rinsed out. And by the time it gets into a retail accessible wrapper, there's really nothing differentiated about it in the first place. And this concept of just allocating across inexpensive beta goes out the window. So how do you think about regulation, especially in a world where the investors are less and less sophisticated? And is it plausible to think about having regulation wrapped in greater transparency and education? It's a very, very hard thing to do. If we could solve for that, I think you and I would get a Nobel Peace Prize and be sitting on a beach somewhere.
I don't think I'm going to win any favors here by saying I actually think the SEC has done a pretty good job over the last couple of years. From my perspective, from a regulatory change, in the last 3 to 5 years, they've implemented a new marketing rule, a new liquidity rule, and a new derivatives rule. Liquidity rule is more reporting. I actually think, as much as I consider it to be a bit of a pain in the ass, in the long run, forcing managers to report on the liquidity of their holdings and maintain to a certain standard, I think is important. At the end of the day, if you're going to have what are supposed to be daily liquid vehicles in a mutual fund and an ETF, you need to ensure that the holdings and the portfolio as a whole are liquid enough to satisfy redemptions. I don't think that's a bad thing. The marketing rule, again, doesn't affect most people, though it does affect what they see. Providing more clarity about what is definitively marketing versus what is not definitively marketing is very helpful for me as an asset manager. They provided a very clear line as to research, for example, is not considered advertising. So I can write a research paper and it is not going to fall under the same marketing standards that me writing about a service or a product would. Again, very useful and actually clarifying from a regulatory perspective. I know most people don't want more regulation, but in these cases, I think they've done a really good job on helping asset managers know where the line is. The third one to me is so crucial, and it's this 18F4 derivatives rule. Very obscure, but hugely impactful, because prior to this rule, there was not really clear guidance for asset managers as to where terra firma was with regards to using derivatives. So yeah, you had funds that were trading managed futures, but how high could you run the vol? Could you run a 10 vol managed futures program? That probably has you around a gross leverage of 300%. What about a 40 vol program where you have gross leverage of 1,000+%? Is the SEC going to frown on that? There was no real clear line. And I think this new rule ended up being very thoughtful, where they didn't just draw an arbitrary line in the sand and say, you can't have this much leverage. What they said was, if you're going to use derivatives, you have to run a risk management program. And I won't get into the nitty gritty details, but this risk management program, I think, is for the most part open-ended enough that people can be thoughtful in the implementation, but they provide very clear guidelines as to this is considered safe, this is not safe. If you start to get into the gray zone, this is the type of reporting you need to do, and this is how you get back to safe. And it allows us to operate our products, which take advantage of derivatives for that capital efficiency, and know we're on the right side of regulation because we know very clearly where the line is. And again, to me, that's very helpful from a market perspective. We can complain about regulators all we want, but if you live in a regulated world, if you're going to operate in a regulated industry, you play by their rules. And it's better when the rules are clear. And I think they've done a really good job, at least in the space I operate in making those rules more clear over the last 3 to 5 years.
Not to get too wonky on this derivative rule, try to size risk is a very difficult thing to do. And VAR has been out there. Maybe it's the best we have. But is that the best measurement tool when I'm thinking about my left tail exposure? Or will generative AI come along with something? Or maybe there is a better thing to point to? What are your views on measuring that risk?
So I think VAR is one of those cases where it's not all models are right, but some are useful. VAR is definitively wrong. Whatever your VAR measure is, there's no way it's that numerically precise that is what your risk level is, but it's directionally correct. And the SEC, this rule basically says you can elect one of two benchmarks. You can say your 20-day VAR, the type of losses you would see in a worst 5% case scenario over the next 20 days, either has to be less than 20% or less than twice your benchmark VAR over the same period. And so they don't say how VAR has to be implemented. They say this is the minimum implementation. You have to at least use 3 years of data. And there's some really bad implementations of VAR out there. Or you can be very thoughtful and be a lot more rigorous. We built our own in-house derivatives risk program, and we spent a lot of time implementing it. To not say that we think VAR is going to be any more accurate, but to try to dig at the nuances of how you would measure VAR thoughtfully with simulation-based approaches and factor-based approaches. And what are we shocking to try to get to those VAR levels? How much data can we get? All that stuff plays a really important role, that risk program. But our risk program might not look like anyone else's. It's up to each advisor to run the risk program that they think is best for their product. And so is VAR correct? Absolutely not. But at least it tells us what the SEC is going to care about. I might disagree whether VAR is the right way to go about this, but at least I know, okay, this is what they care about. This is my target now.
I appreciate those thoughts. If we go much deeper, it'll be over my head. So we'll let that go for the time being. We just have a few minutes left, Corey. And I think this is on the 15th anniversary of Newfound, and you had your 15 ideas and lessons. I think you didn't stop at 15. You added 16. And I think it was the 16th, which was the market is right. That struck me because I was flipping around this weekend, and up on one of the movie channels comes The Big Short. And the people that saw that housing trade early eventually were proved right. But the market was right for so long, they looked like idiots. And maybe there were some people that lost their shirt in that process. But if you're trying to add value, and maybe part of the answer is you're just trying to have greater diversification through access to beta, but how do you reconcile the concept with the market always being right versus so many people that are in the alpha business that are out there?
This is coming from a piece I wrote, 15th anniversary of Newfound, where I said it's 15 lessons I've learned over my career. And it wasn't that the market is right. It's that I start with the presumption the market's right, which is very ironic because I don't want to timestamp this recording, but this morning, GameStop is up over 100% because Roaring Kitty came back to Twitter. Clearly, the market is not perfectly efficient. And arguably, there's plenty of places where there is a considerable amount of inefficiency, or else I wouldn't run active strategy. So clearly, I don't believe the market is perfectly efficient. What I have changed my view on over time is I probably went from being a very brash, arrogant young man who had too much faith in his own intellect to getting a little bit older and hopefully a little bit wiser. And when I see something wrong in the market, my first instinct is not that the market's wrong. My first instinct is I'm missing a piece of the story, because I know a lot of incredibly sophisticated people who are trading these markets. And if the market's trading at that price, I have to ask myself, why didn't one of these brilliantly sophisticated people already whack that price back to where it should be? Why is it trading there? What am I missing? And maybe there is a reason, like institutions aren't willing to step into high meme beta names anymore and be on the short side because they don't want to get squeezed out. And so they can trade in an incredibly weird way. That might be a very valid reason. But the larger point for me is, especially for big macro trades, what's the yen trading at? What are some other government sovereign bonds trading at? When I see something that seems out of line, to my understanding, my presumption is I don't have the whole story yet. That this price probably makes logical sense if I got that missing puzzle piece, rather than me being arrogant and saying, I know all this, I have all the right answers. It's just a reminder for me, go do the extra legwork to make sure you figure out that you indeed do have all the missing pieces before you say the market is actually wrong.
Great advice, Corey, to close this out on. And there are a lot of very successful people in this industry, a lot of egos, and there's nothing wrong with that. But always being willing to recognize we have a blind spot. We all do. We're humans. And no matter how talented you are, no matter your track record, having a little bit of humility to take a step back and say, am I missing a piece to this puzzle before you go all in? I think it's great advice.
I couldn't just do 15. I had to give myself a little, the extra candle on the birthday cake. 16th advice to just say, okay, remind to have a little bit more humility, hubris.
Well, when you come to your 20th year, I'm going to skip the first 20 and go right to 21, and I'll probably get what I'm looking for there.
Absolutely.
So, Corey, thanks for a great conversation. I appreciate all that you do. I think a lot of what I've quoted here is not behind a paywall, and a lot of non-commercial advice there that I think investors can use. I would encourage people to take a look at what you're putting out on your site as well. But Corey, thanks for your time and insights today. I enjoyed it.
Really appreciate it, Bill. Thank you for the opportunity to come on.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CIO Association and subscribe to the show at CIA.org. That's CAIA.org. See you next time.